Target stock is down 32% over the past year, which has led to a phenomenal dividend yield of 4.3%. And better still, their trailing price to earnings ratio is at just 11.4, which is 38% below their own 5-year average PE ratio of 18.5. But Target is facing some serious challenges, with people boycotting their stores and tariffs threatening their profitability. Today's video will be an in-depth analysis of Target stock, covering business operations, fundamental and technical analysis. Target opened their first store in 1962 in Roseville, Minnesota, and they now operate stores in every U.S. state and the District of Columbia. As of their latest annual report, they operate 1,978 stores, which is a 5.9% increase in store count since 2019. Target defines themselves as a general merchandise retailer, and they break down their products into 6 main segments, with their largest segment being food and beverage at 23% of sales, followed by household essentials at 18% of sales, which includes items like toilet paper, cleaning products, and storage tools. At 16% of sales, 2 categories are tied, which are apparel and accessories, and home furnishings and decor. The next largest segment is hardlines, coming in at 15% of sales, which includes products like electronics and sporting goods. And their smallest business segment is beauty at 12% of sales. So Target is well diversified across various business segments. As you probably know, Target is primarily a brick and mortar business, but nearly 20% of their orders are originated online, which shows that Target offers consumers value, whether it's through shopping online or in store. Now let's cover the macro level pros of Target's business. One of the most important advantages to Target's business is that through various economic cycles, they have proven to have a durable business model, which we can see by the fact that they only had a nominal decrease in sales of 0.8% during the Great Recession, and through their status as a dividend king, having a dividend growth streak of 53 consecutive years. So despite Target selling items that appear non-essential, they are essential to the customers who buy them. One of the reasons that Target has been so durable could be that they are a one-stop shop for basically any household item, which makes them a rare business, along with a few other one-stop shops like Walmart and Costco. Another interrelated benefit to Target's business model that seems to have made them more durable is that they are well diversified by product category, having 6 product segments that are significant, the largest category not being too large at 23% of sales, while their smallest category is still meaningful at 12% of sales. And even better, their largest segment is an essential category, which is food and beverage. Another attractive element to Target's business is that they partner with many other companies to sell their products in-store or have whole stores within Target, like CVS, Starbucks, and Ulta. Having unique businesses like these within Target creates a more specific reason to go to Target and will inadvertently lead to more products being sold at Target. Speaking of stores within Target, they used to have Pizza Huts within their stores. Comment down below if any of you remember this era of Target. The last major pro to Target's business is that they own the majority of their stores at 78% of stores, which reduces cost of operation due to not paying a lease. And I imagine they have some fairly well-positioned properties since they are an old and well-established retailer. I think Target is a fairly durable business, but there are some major risks to consider. The most prominent being the rise of e-commerce, and more specifically, Amazon. Without checking every product that Target offers, I would assume Amazon has each of Target's products and tens of thousands more to offer, probably at a cheaper price. Not to mention that you can order from Amazon from the convenience of your own home. This risk of e-commerce may not fully disrupt Target, but it surely has caused diminished revenue for Target and will continue to do so as Amazon and other online retailers continue to gain market share. Another substantial risk to Target is a social one. Target recently halted some of their diversity, equity, and inclusion goals along with their reporting of these goals, which has caused social backlash and a call to boycott Target titled The Target Fast, which began on March 5th and lasted for 40 days. Although this didn't seem to materialize in their revenue quarter over quarter, which was only down by 2.9% and accounted for about 29 days of the 40-day fast. Nonetheless, this social sentiment could still impact Target's revenue into the future. The final risk to Target that also applies to almost all American retailers is tariffs. Target states as of their most recent 10K that China is their single largest source of imported merchandise. Several tariffs have gone into place, including a baseline tariff on nearly all imports of 10%. Additionally, most Chinese imports are subject to a 30% tariff, and who knows if this will be the full extent of the tariff war. Being that a tariff is effectively an import tax, Target, as the importer, will have to pay more to import those goods, and those costs will need to be pushed on to the consumer for Target to remain profitable. This process will take time and may result in Target having reduced profitability until they can effectively price their merchandise, accounting for the current and pending tariffs. Now let's get into the foundation of Target's business, starting with revenue. Since 2016, Target's revenue has been fairly consistent, but slow growing, at a 10-year compound annual growth rate of 3.8%, which for comparison is actually higher than Walmart's 10-year revenue CAGR of 3.5%, and shows that Target is still keeping pace with a comparable company, although Walmart does sell more essential goods than Target. In terms of free cash flow per share, shown on the right, Target's results have been somewhat consistent, except for 2023, but since 2016 to the trailing 12 months, their free cash flow has barely grown, which is pretty poor for such a long time frame. The next metric we see on the left is shares outstanding, and this is the first metric where Target excels, having an impressive annualized share count reduction of 3.1%. So despite their slow revenue growth and actually declining free cash flow on a non-per share basis, they have still increased shareholder value through share count reduction. Another all-important metric to consider, especially while interest rates are high, is total liabilities plus cash and equivalents compared to free cash flow. Target isn't doing so well by this measure with a total liabilities level to free cash flow of 13.0 times, which isn't particularly reassuring. In terms of valuation, Target is priced as if it's going out of business, at a trailing price to cash flow of just 7.2 times, which is a 32% discount compared to their own 5-year average of 10.6. Or if we looked at the trailing PE ratio, currently at 11.4, compared to the Consumer Staples ETF, XLP, at a PE of 23.3, Target is trading at a massive discount relative to its peer group. I'm guessing most people interested in buying Target are likely in it for the dividend, and Target's dividend looks to be fairly safe, with a trailing free cash flow payout ratio of 58%, although the payout trend has increased rapidly over the decade, beginning at just 30%, so hopefully their payout ratio flattens soon. In terms of their dividend streak, Target is a dividend king, having an uninterrupted growth streak of 53 consecutive years, which proves their business has been resilient through various economic cycles. Although e-commerce and Amazon are a relatively modern disruptor to Target's business model, and time will tell how Target fares in the modern landscape. Their dividend yield is where Target seems to offer the most value, which is currently near a 5-year high at 4.3%. Which compensates for the recently slow growth, with a 1-year CAGR of just 1.8%, a 5-year CAGR of 11.2%, and a 10-year CAGR of 8.0%. In summary of the fundamental analysis, I think Target is trading at a value based on the trailing price to cash flow and price to earnings ratio. And if you believe their dividend is safe, the high yield looks quite attractive, along with the potential for long-term dividend growth and valuation expansion. Here we see a 10-year price chart for Target. I typically showcase stocks over a 5-year period, but Target has been so beaten down that it has become a value over a 10-year period, which we can see by noting how far below the current price is from the average price, shown by this center yellow standard deviation channel line, which is currently at $179, while the current price is 42% below average at $103. Or in other words, Target is trading at a discount of 42% compared to the average price, which is a massive discount. The next feature of this chart to note is levels of support and resistance. Recently, Target looks to have found support around $89 and is currently facing a less prominent resistance level around $103. And if Target is able to push through this resistance level, it looks like it could run all the way up to the next resistance level around $140. Lastly, at the bottom of the chart, we have the Relative Strength Index, or RSI, which shows that Target is trading at a deep value at a current level of 37.4. And the RSI has only reached this low point twice over the past decade. And better yet, the RSI looks to have found a bottom, reversed, and is heading back up. But we'll have to wait and see what Target does next. If you're looking for another value stock offering a high dividend yield and a time-tested track record, check out this video covering Merck stock.
I'm not a financial advisor, and this is not financial advice. This is for educational and entertainment purposes.